Welcome to Stock Talk with Nico Kritikos. Today, we're going to be reviewing Medtronic stock, ticker MDT. This is a medical device company, and they are one of the largest in the world. I believe either number one or number two. They have a market cap of a little over $100 billion, and this stock is now it's down over 28% on the year, and it's at a 5 or 6 year low right now. So we're going to go through, review it. We're going to look at what I like about the stock, what I don't like, and if I would consider buying the stock, because I never owned it before, but it looks interesting. So first thing, is the stock down? Yes, it's definitely down over 30%. That's going to get a check. Is the revenue and net income increasing? If we look at the last couple of years, it's pretty consistent, pretty steady. So I wouldn't, there's not huge growth here, just a couple percent, but good enough to where we can say, they were doing 3.5, 3.1 to $4 billion of income, and they just did $5 billion of income. So, not bad, not a ton of growth, but good enough to where it proves they're consistent. Now we're going to look at the PE ratio, and the PE ratio is about a 15 because they're so it's an $80 stock, and they're going to do a little bit over $5 of EPS. So PE ratio is about a 15, and I think that's pretty fair. I think that's where it should be trading. Now, number 5, are they innovative or do they have a moat? At first, I was going to put yes because of how big of a company they are. But when you think about it and you compare it to their competitors, they're really not. I did read some articles that they are investing into like some more automation to incorporate into their surgery equipment. But the problem is the other companies like Intuitive Surgical, they've been doing this for years now, and they're so much further ahead that I wouldn't call this company innovative. Do they have a moat? Well, maybe because of how big they are, but still, I think they're kind of weak in that category. Number 6, is the industry growing? Yes, it is. Not only for medical devices, but especially for automation incorporated into the equipment. So that's going to be something for the future. They also listed neuroscience as one of their growth vectors, even though it's only expected to grow 5 or 6%. So we'll get into that in a little bit. But number 7 is, how's the return on capital? No, it's not very good. It's actually decreased from where it was 10 years ago. And for the last 7 years, it's been under 7%. So under 7% is not good at all. We want like 10% plus. So, and it shows in the stock chart because that's part of the reason why the stock hasn't gone anywhere in 6 years. So those numbers, and when you compare it to their other competitors, look at not only Intuitive Surgical, but I believe like Johnson & Johnson's on the list as well, and just 7% is not good. So that's going to get a no. Number 8, how are the margins? The margins are, I put yes because they're good enough, but once again, I think they could be better. Right now they're at about a 14% net margin, which is not bad. That's definitely not bad. But I mean, look, it was over 20% for a couple years, and it's kind of just hung out in this 10 to 15% range. So it's not bad. Could be better though, but I'll give it a check. Do they have healthy cash flow? Yes, it's not perfect, but it's good enough to where I would consider it healthy. Operating cash flow has stayed right around, I think it's pretty consistent around, let's see, the $6 or $7 billion mark, and cash position has gone from anywhere from 3.5 to $5 billion. And then their free cash flow is right around this $5 to $6 billion too. So those are definitely, good numbers. Do they have diverse revenue streams? Yes, and we will look at that right here. We can see that here's their segments. Cardiovascular is 36%, medical surgical is 28%, neuroscience is 29%, diabetes is 8%. So I think they have enough different segments to where they're diversified, and they could be flexible with where they want to invest their money. And I think it kind of opens up, how can I say this? I guess they have different places where they can move things around if they need to, if one sector is hurting, then another sector could be growing. So I think they're okay there. They have more assets and liabilities. That'll get a check. The equity is actually like 50%. They have $50 billion of equity, and it's a $100 billion company. So very strong there. Number 13, this is one of my favorites. One of the most important things to look for is the share count decreasing. And if we look over the last 7 years, we can see it averages about minus 1% per year. So that's pretty good. That's going to get a check. Are insiders interested? This is one of the bad things. Not that this always this shouldn't totally determine your opinion on it, but the insiders definitely have not been buying anytime recently. In fact, they've been selling ever since the last purchase wasn't until December of 2021, so about a year ago. And they bought it $100 a share, but since then they've been selling at 100 all the way down. Even in October, somebody sold for $81 a share. So kind of makes you question it. Now, when the new numbers come out, maybe we'll see the stock. The stock has been lower since then. In this the last 2 months, it's come down under $80. So maybe we see some insiders purchasing there, but that's not a great sign. Do they have respectable management? I'm going to say no, just because I think they're not doing as good as they could be. They're not keeping up with competitors, and the stock chart is at a 5 or 6, 7 year low. That's not good. That's definitely not good. And the net margins are okay, and the return on capital is under 7%. That's not good. That means management probably is not doing, a good enough job. Then we get to number 16. Are their current assets more than average earnings? Yes, they are. I believe the current assets are about 25 or 30 billion, and their earnings are average about 4 to 5 billion. So that's fine. Number 17, do they have a healthy dividend? Yes, they do. It's about a 3.3% dividend and payout ratio of 81%. But if you look at their numbers, it's normally like it's normally more, it's closer to about a half of their, operating cash flow was 6.3 and the dividends were 3.5. So it's almost half, right? And then you see other numbers. Let's see, financing, cash dividends 3.3, and that previous year they did 7.3. So that's, we're talking like that's 40% or so. So I'm not too worried about the payout ratio. I think that's good enough. And then finally, is the company over 20 years old? Yes, it is. This company was founded in 1949. So overall, it's definitely one I would consider. There are a couple things wrong with it. I really would like to see numbers like the return on capital is probably the number one thing here that I have a problem with, because if it's under 7%, that's not good. The net margins are, you can have a successful company and stock without giant net margins, but return on capital, that needs to be higher. And I think they need to show that they can compete with a company like Intuitive Surgical, who has been, automating their technology and innovating for the last 5 to 10 years. So they need to show that. They need to increase the return on capital. The share count is definitely okay. That's fine. That having that dividend definitely helps, makes it more convincing. And the fact that they are, let's see, we type in biggest medical device company, we can see that they are on the list. And so that's definitely another thing that convinces me to buy it as well. The other thing, I think buying at this price, I think we're definitely going to see it go over $100 a share, probably $120 a share at some point. But my thing is there other stocks out there that are a better investment? So that would be the only reason I wouldn't want to buy this. Well, this doesn't look like it wants to load. But yeah, so that's Medtronic for you. If you have any questions, comment down below, and I will see you in the next video.